There's been a lot of discussion of where oil prices will go next year. To weigh in with his thoughts, we have Rory Johnston, founder of Commodity Context. Good to see you, Rory. Thanks for joining us.
Thanks for having me to end the year.
Absolutely. We hear a lot of talk about oversupply in the oil market, weakness in demand from China, and you are forecasting the potential for oil at 50 U.S. a barrel. Are we talking about Brent or West Texas, and why? What would be the drivers?
So I just to clarify, I think there's a scenario in which prices do fall that deep, and I think that the tail risk is tilted to the downside given OPEC's outsized current support for the market. But I do want to stress that my current base case outlook is for prices to gradually grind a bit higher from here. That is on a Brent basis. Right now, we're trading at around $75 a barrel. I see those likely heading slightly higher towards the high 70s to low 80s for the balance of next year. But I do think that given how much OPEC is supporting the market, they need a lot of things to go right next year in order for them to begin easing. And the longer they hold those cuts, the higher the chances that arrangement kind of implodes in rapid fashion. And that's the scenario that, you could see 2, 3, 4 million barrels a day dumped back onto the market. And that's what would bring us below $50 a barrel. But I do want to stress that remains a tail risk. But I think the risk of sub 50 is higher than the risk of us jumping back into the triple digits through next year.
All right, fair enough. Now, as far as OPEC Plus, we've had some guests who believe that they'll be on hold for all of 25 in terms of their quotas. Where do you stand on that?
I think that's the best guess right now. They've already delayed this so-called cut easing 3 different times we've now got a full 6 months of extension versus the initial planned start. This is now planned to start in April. I think the best guess is that, yes, they're going to continue delaying that. But I do think that my current outlook for next year does see the potential that they could have some room to ease. The question, of course, in any of these scenarios is at what price are they going to accept that easing? I think even if you do have continued deficits that on a fundamental basis give them some room to ease into the market, if pricing is still very, very low, as we see right now, I don't think they're going to take that opportunity.
Do you have any thoughts, Rory, on the Canadian market? We know that Brent and West Texas are the big dogs and they drive everything. But any thoughts on the Canadian oil sector for 25?
Yeah, I mean, the benefit of the benefit to the Western Canadian oil patch this year is that with the completion of the Trans Mountain Expansion project, we have, we've tripled our access to Pacific Tidewater. We have the largest overhang now in surplus egress or pipeline capacity, more than we've had in more than a decade. I think that provides the Canadian producing kind of sector, far more ample allowable space than they are used to operating. And based on drillers I've spoken with out there, their general view has generally been, give us a pipeline and we'll fill it. The thing I will note about Canadian production, though, is that this year Canadian production has come around the second strongest source of non-OPEC plus production growth this year at nearly 300,000 barrels a day year over year. That matches the heyday of oil sands expansion that we saw in the early 2010s. I think the big question is whether or not that level, that pace of production growth persists into next year. Whereas you have organizations like the US EIA that sees that could further accelerate to almost 400,000 barrels a day next year. Whereas organizations like OPEC and the IEA see that easing back to more like 100, 150. I think that's going to be the big question. And I think one of the biggest drivers of whether or not we end up at the upper or lower end of that will be what ends up happening with President-elect Trump's threatened tariffs against Canadian production and Canadian exports, given that those tariffs will dramatically reduce the price, received by those producers and the incentive of those producers to increase production.
Rory, we've talked to a number of people who believe that energy will be excluded from any tariffs. Do you believe that?
I think that is, still the best base case assessment of what we've seen from Trump in the past. However, I think what we have seen is that this is obviously an area of unique vulnerability for Canada versus a lot of other countries, given the size and overwhelming destination of all of our crude going to the U.S. on fixed pipelines. We really don't have any other real kind of outlets for our crude in size. So while I do think that ultimately those are excluded, I think it's very likely that the incoming president will use our kind of dependence on the U.S. market as leverage for other trade negotiations.
Now, the incoming Trump administration has talked about higher production of oil in the United States. And, of course, the mantra is drill, baby, drill. But do you think that will happen, and or will companies be reluctant because the oil producers in the U.S. are a lot more disciplined now than they used to be?
Yeah, I mean, I haven't put a huge amount of stock in President-elect Trump's drill, baby, drill rhetoric. I think as we've seen throughout the pandemic years, that previously voracious, insatiable appetite for growth that we saw from the U.S. shale patch in the decade prior to COVID has largely disappeared in a pursuit of profitable barrels over kind of growth that we've seen in the past. That said, we are already seeing that pace of growth decelerate considerably from upwards of 1.5 million barrels a day of growth last year to more like half of that pace this year, and a further expectation of slowing next year. Now, I think that a large push of deregulatory efforts from the incoming administration would, all else equal, reduce the break-even prices for these producers. But I think that's something that would take years to trickle through to new production growth, rather than something that would turn around and kind of hit the tape next year. I think the incoming president has far more near-term control over Iranian exports than he has over Texan and New Mexican production.
All right, Rory, thank you for the table setter for 2025 in the oil sector, and Happy New Year to you.
Happy New Year to you as well.